Hello and welcome to Untaught Wealth. This is the kickoff of our Beginner Investor series. This series is dedicated to those who are just beginning to learn more about investment accounts, what types of accounts to use, how to manage their savings, how to manage an emergency fund, etc. So just the basics, how to get started. So we have five principles that we're going to kind of talk through today and walk through. But just to start off, we've all heard the saying, you need money to make money. And that is, there is a lot of truth to that when it comes to investing. Very few people are just given money as a gift and have investments already generated for them. Most of us have to work through it through these 5 steps to start our investing path. So the first one is to live within your means. And all this means is if you're making 80,000 a year in an income, you need to be spending less than 80,000 a year to actually get started to invest. The reason why is because you need to have some kind of excess cash on hand. The faster you can implement a savings mindset, the easier investing will become. You do have to learn to save a little bit of each paycheck along the way so that you can contribute to the investment accounts or your emergency fund. So, number two brings us to our emergency fund. What is an emergency fund? Emergency funds are anywhere between 3 to 6 months of your monthly expenses. And usually these are used when you lose a job or your partner loses a job and you have to cover your living expenses with this emergency fund. Most emergency funds, when I'm talking to beginner investors, the easiest way to get them started is to use a high yield savings account. Nowadays, if you're watching this in January 2025, high yield savings accounts right now are anywhere between 3 and 4% yield. So that's the competitive rate right now. So if you're looking for a high yield savings account, I would look for one that has no fees or minimal fees and is earning anywhere between 3 and 4% annually. High yield savings accounts, the reason they're good for emergency funds is because they are same day accessible. So you can transfer money out of that account into your bank account to pay for bills, and it will all happen in the same day. Now, as we move further into talking about different types of investment accounts, we'll talk about how some investments are not same day liquid, is what it's called, or same day accessible. Some investment accounts in general you can't touch until you are retired. So money can't be moving in and out of certain accounts just on a daily basis. So that's why we recommend that the high yield savings account is probably a great place to put your emergency funds. It's just easily accessible. You can get a decent return, um, and you're not locked into any, types of investments. As far as the 3 to 6 months and how to choose that, ideology wise, they say if you're a single income home, you should probably go with 6 months. If you are a dual income home, you could probably get by with 3 months of your emergency savings, or your monthly expenses in an emergency fund. Um, Also, though, just keep in mind if maybe you're commission based, or maybe you're in an industry that's just really competitive and there's very few job openings, and that would prompt you to save more and have more in your emergency fund because it's probably going to take you a lot longer to find a new job if you were to lose the job you have. As far as how much to save, that goes off of how much you're spending currently. So if you spend about $3,000 a month and you're trying to get a 6 month emergency fund of savings, then you need to have about 18,000 in your high yield savings account. And that will continue to grow. If it's invested in a high yield savings account, you're going to get that 3 to 4% annually. And just know that that is your emergency fund. So if you needed to pay for something today and you didn't have time to transfer money from an investment account, or if your partner loses a job or you lose a job and you need to cover monthly living expenses, then this is the account that you would use. Okay, so we have covered the first two. The third one, strive to save 20 to 30%. Now, this goes off of just a general rule. If you can get in the habit of saving 20 to 30% of your paycheck, um, each paycheck, then you will be well on your way to building up that emergency fund and then being able to start investing. Now, 20 to 30% is obviously not uh, easy for most people, and especially not when you're starting out. If you just got out of college and you're making 60,000 a year and your expenses are 55,000 a year and you're just barely making it by, saving 20 to 30% is not going to be ideal. So just start with where you can start with and just know that your overall goal is to get to the point where you could be saving 20 to 30%. If you have to start with 10% in 2025 and then you boost it up to 15% in 2026 because you get a raise in a salary next year, then that's the way you go. And just keep in mind that as you do get salary raises, you also do need to increase your savings rate. Don't just spend that extra money and think, "Oh, well, last year I was making, 60,000 a year and now I'm making 70,000 a year. I get to spend 10,000 more dollars this year." Don't think of it like that. Get in the mindset now that you can take that $10,000 and put it towards savings and just keep your lifestyle the way it was the year prior. Um, that will set you up for success in the long run to just learn to live beneath your means. Just because you get a salary increase doesn't mean you should just go spend it on whatever you want. Learn to increase your savings along the way as well. So once you have those mindsets and those habits, you're making good money and you are spending less than you make, and then you're also building up your savings. You already have your emergency savings in place, and now you have extra cash, and you're thinking, okay, I have my 18,000 in emergency savings done, and now I'm saving 25% of each paycheck, and I have extra cash, and I don't know where to put it. If you're starting to look into long-term retirement investments, that's when you would want to open up a Roth account. So a Roth IRA is an individual retirement account that allows you to grow your investments, grow your money tax-free. You don't pay taxes along the way on any of the investment growth, and you don't pay taxes when you pull out the money in retirement to live on those funds. So we suggest a Roth IRA because it does have an income limit. So if you're a single person filing your taxes single, um, your income limit for a Roth IRA in 2024 was about $146,000. So that means as long as you're making under $146,000, you can contribute directly to a Roth IRA. The annual contribution per year right now is $7,000. So that means, if I'm making $60,000 a year and I'm able to contribute a full $7,000 to my Roth IRA, I can. I'm able to do that. You know, you can put in the 7,000, say you're getting 10% annualized return each year. That's going to grow and it's going to grow tax free. You're not going to pay taxes on it next year or the following year. You won't pay taxes on it when you pull the funds out in retirement. And that's the nice part about using a Roth IRA account. The other side of IRAs is the traditional IRA account. And this is what you have to use when you are no longer under the income limit. So say I got a major pay bump and I went from 60,000 to 150,000. Now that I'm over that $146,000 income limit, I have to contribute to the traditional IRA. And a traditional IRA only grows tax deferred, doesn't grow tax free. So the contribution amount is the same. I can only contribute 7,000 total to this account this year. I can still, invest it in the same investments and get 10% annualized if that's what I was getting in my other account. And it's growing. It's just tax deferred. So I don't pay any taxes on it this year, next year, the following year, all the way until I'm in retirement age and say I turn 70 and I decide, okay, I'm going to start pulling income off of this traditional IRA account. That's when I will pay the taxes. And you pay the taxes as an income tax. So say I accumulated $1 million in this account, and each year I need to pull off $20,000 to help supplement my income. In my taxes, it's going to read that I have an income coming off of this traditional IRA of $20,000 a year, and I'll have to pay taxes on that amount. So that's the difference between a Roth IRA and a traditional IRA. The biggest one, at least. One is tax deferred, one is tax free. And that's why we suggest opening the Roth IRA first, is because you want that tax free growth as long as possible. And your income is most likely going to grow and increase. And so you want to build up your Roth account as much as you can in those years where you're earning a lower income. Now, the final point I want to start with or end with is liquidity structure. So when we're talking about investment goals, Roth accounts, traditional IRAs, those are long-term investment goals. You usually are building an investment or you're building a portfolio that's going to lead to retirement. That's what you're going to live on in retirement. There's other investment accounts, just normal brokerage accounts. And sometimes these can be used for long-term investment goals that are before retirement. So maybe you want to save up for a new home or a car. You can use a regular brokerage account and save up for a home or a car within that account. Um, there's the pros and cons of that is that you're gonna most likely earn more than your 3 to 4% that you would have earned in your high yield savings account. But you do run the risk of losing some funds if the market goes down. So in a high yield savings account, everything is same day accessible, like we talked about earlier. It's also 100% protected. So if you put 10,000 in there, it's going to grow by 3 to 4% from current today's rates, and your 10% is protected. You're not going to lose that money. If you put $10,000 into a brokerage account, you probably can get, anywhere between 10 and 12% as a return, but this isn't fully protected. So there's a chance of losing that money as well. So there's different liquidity features in each account. And then when we're talking about Roth IRAs and traditional IRAs, those are the accounts you can't touch until you're at least 59 and a half. So those are not accounts I would use if you're wanting to save up for a house down payment or a new car. Then taking it one step further within the account itself. So if we're in a brokerage account, you might have investment A that is same day liquid, meaning I can sell that investment today and I could pull the cash out tomorrow and put it in my bank account. You might also have investment B. And investment B is a longer investment. Say it's 3 years. So if I was saving for a house and I needed to make a down payment in a year, I would want to put it into something like investment A, not investment B. So there's just different different time frames and different lockup periods for investments, and you just need to be careful which ones you're choosing based on the goals that you're looking to accomplish. So, all right, this concludes our first episode of the Beginner Investor Series. If you have any questions, feel free to email us. Um, we will be releasing the next episode next week, and we'll go from there. We'll talk a little bit more about account types and how they function.